is a financial story unfolding in Japan that most Western investors haven't fully grasped yet. It sits at the intersection of three things. First, a country drowning in nearly 12 trillion yen of low yield savings. Second, a pioneering Bitcoin treasury company with an audacious capital market strategy. And third, a new financial instrument designed specifically to bridge that gap. That instrument is Mars, Metaplanet Adjustable Rate Security. In my analysis, it may be one of the most structurally interesting preferred share products to emerge from Asia in a generation. In this presentation, I will walk through exactly what Mars is, why Japan's worst group of savings creates extraordinary demand potential, what the regulatory constraints look like, and how Metaplanet's Bitcoin income generation business becomes the critical revenue engine that makes the whole structure work. What is Mars, and why does the structure matter? MARS stands for Metaplanet Adjustable Rate Security. It is Metaplanet's Class A preferred share, sitting at the very top of the company's equity capital stack, senior to both the Class B Mercury preferred shares and to common equity. The key design feature of MARS is its adjustable monthly dividend. Unlike a fixed rate bond or a standard perpetual preferred, the dividend on Mars fluctuates based on where the share trades relative to par value. When the share price dips below par, the dividend rate rises, attracting buyers and supporting the price. When it trades above par, the rate adjusts downward. Think of it like a self-correcting yield mechanism. If the share gets too cheap, it automatically becomes more attractive as an income instrument. If it gets expensive, the yield compresses and investors capture capital gains instead. The goal is price stability, which is exactly what a retail income investor in Japan wants. Critically, Mars has no conversion rights into common equity. This means it is completely non-dilutive to common shareholders. From a Bitcoin per share perspective, the metric I care most about when analyzing Bitcoin treasury companies, Mars is a clean structure. It raises capital without diluting the Bitcoin exposure of existing shareholders. Japan's sleeping giant, 1,122 trillion yen in low yield deposits. Let me put a number in front of you that is genuinely staggering. According to Bank of Japan data reported in December 2025, Japanese households hold approximately 1,122 trillion yen, roughly 7.4 trillion US dollars in cash and deposits. That represents nearly 49% of all household financial assets in the country. That is an almost incomprehensible sum sitting in bank accounts earning almost nothing. Ordinary deposit rates at major Japanese financial institutions have averaged just 0.1% per annum. And even after the Bank of Japan raised rates in 2024 and 2025, the average one-year term deposit rate remains in the range of 0.32 to 0.55%. To put that in perspective, a Japanese saver with 10 million yen in a term deposit earns roughly 32 to 55,000 yen per year before tax. That is approximately 200 to 370 US dollars annually on a 66,000 US dollar nest egg. The real return, after accounting for Japan's recent inflation, is effectively negative. Estimating the market potential, 3 demand scenarios for Mars. Let me be clear up front. I am working with scenario analysis here, not a forecast. No one can know exactly how much demand a novel financial product will attract, but we can reason from first principles about what different levels of penetration would mean in dollar terms. Not all 1,122 trillion yen is accessible. Much of it is locked in traditional savings habits, managed by elderly savers, or concentrated in accounts with large banks that restrict product access. A reasonable estimate for the reachable portion: active retail investors, institutional depositors seeking yield, and NISA eligible savings accounts, is perhaps 10 to 20% of the total, or roughly 100 to 220 trillion yen. Even within that reachable pool, a new and unfamiliar product like Mars will not capture a large market share quickly. Japan's retail investor base is cautious and conservative, but the market is enormous enough that even fractional capture represents a transformational capital raise. Here are 3 scenarios. In a conservative scenario, just 0.01% of total household deposits. That represents a capital raise of approximately 112 billion yen, or around 740 million US dollars. In a base case of 0.05% penetration, the raise would be 561 billion yen, roughly 3.7 billion US dollars. And in a bull case of 0.2% penetration, the raise would be 2.2 trillion yen, or approximately 14.6 billion US dollars. Even the conservative scenario represents a capital raise more than 4 times larger than the initial Mercury preferred placement. The base case scenario would be genuinely transformational for Metaplanet's Bitcoin acquisition capacity, per first mover advantage and competitive window. One of the most important strategic facts about Mars is the competitive window Metaplanet currently enjoys. Strategy chairman Michael Saylor stated publicly at the Bitcoin Miner conference in December 2025 that Strategy would not issue perpetual preferred shares in Japan for at least the next 12 months. That was an extraordinary gift to Metaplanet. Japan's perpetual preferred market, as of late 2025, had only 5 listed instruments total. It is a sleepy market that has never seen a product quite like what Metaplanet is proposing. By entering now, and by having Saylor essentially endorse a 1-year runway, Metaplanet has the opportunity to establish brand recognition and investor relationships before any serious competition arrives. The regulatory framework: what Japan requires. Any serious analysis of Mars must grapple with Japan's regulatory environment. This is not a trivial exercise. First, the dividend from net profit rule. In Japan, preferred share dividends must legally be paid out of distributable profits, specifically net retained earnings available for distribution under Japan's Companies Act. This is fundamentally different from the US market. Metaplanet cannot simply accumulate Bitcoin, watch the price rise, and declare dividends from unrealized capital appreciation. It needs actual, realized net income flowing through its income statement. This is a hard regulatory constraint, and it is precisely why Metaplanet's Bitcoin income generation business is so strategically critical. Second, ATM restrictions and the moving strike warrant solution. Japan prohibits the kind of at the market financing that strategy uses in the US. Metaplanet's solution is what they call a moving strike warrant, a variable price warrant structure that achieves a functionally similar result under Japanese securities law. It is a creative regulatory workaround and reflects the kind of financial engineering sophistication I expect will become standard among Asian Bitcoin treasury companies as this market matures. Timeline for public issuance. How long will it take? Stage 1, institutional private placement, was completed in late 2025 and early 2026 with the Mercury preferred shares. Mars has been announced as the next instrument in this progression. Stage 2, TSE listing application and regulatory review, is estimated at 6 to 12 months post placement, assuming consistent dividend payments and strong income figures. Stage 3, a public retail offering, is estimated at 12 to 18 months from initial announcement. That places the meaningful retail launch window in the 2027 timeframe, assuming efficient regulatory processing. Stage 4, scale and continuous issuance, would begin in 2027 and beyond, using the moving strike warrant mechanism to continuously issue Mars into the market. Similar in effect to the ATM programs used by Strategy in the US. The revenue engine, Bitcoin income generation. Here is where the most underappreciated part of Metaplanet's strategy lives. The Mars structure only works from a regulatory and commercial standpoint if Metaplanet can generate sufficient net income to pay dividends legally. The Bitcoin income generation model is conceptually elegant. Metaplanet separates its Bitcoin holdings into two pools: a long-term strategic reserve in cold storage and a working pool deployed through structured option strategies. The options desk sells cash-secured puts and calls on Bitcoin, collecting premiums that flow directly into operating revenue. The results have been remarkable. In Q4 2025, that segment generated approximately 26 to 27 million US dollars in quarterly revenue. For the full fiscal year 2025, the Bitcoin income generation segment generated 8.58 billion yen, approximately 54 to 55 million US dollars, significantly exceeding Metaplanet's own earlier forecasts. Looking forward, Metaplanet has guided for fiscal year 2026 revenue of over 100 million US dollars, with approximately 97.5% of that coming from the Bitcoin income segment. And it is the legal foundation that allows Metaplanet to pay preferred dividends under Japan's Companies Act. What Mars means for Bitcoin per share. Let me bring this back to the framework I use for all Bitcoin treasury analysis. Bitcoin per share. Does Mars increase Bitcoin per share? And if so, by how much? The answer is unambiguously yes. And this is what distinguishes Mars from common equity raises. When Metaplanet issues new common shares to buy Bitcoin, existing shareholders experience dilution. Their percentage ownership of the Bitcoin pile shrinks, even if the pile itself grows. Mars has no conversion rights. No new common shares are created. The capital raised goes entirely to Bitcoin acquisition or to funding the Bitcoin income business. Every unit of Bitcoin acquired through Mars proceeds is additive to Bitcoin per share without reducing the share count. This is the core capital efficiency argument for preferred equity in Bitcoin treasury companies. And it is why I view Mars as a structurally superior instrument to additional common equity raises when the goal is maximizing Bitcoin per share. Risks and honest caveats. I would not be presenting this without addressing the genuine risks. First, Bitcoin price dependency on dividend coverage. The Bitcoin income generation business is correlated to Bitcoin price and volatility. In low volatility environments or extended bear markets, options premiums compress and revenues decline. Coverage ratios provide substantial buffer, but the dependency is real. Okay, von Array Tom's smartishi will have burnesitionet polity peak. First, Pinanic solutions are not fast-tracked. The FSA and TSE have shown increasing scrutiny of companies with large cryptocurrency exposures. Any change in regulatory posture could delay or complicate a public listing for Mars. Third, competition and market saturation. Metaplanet has a 12-month head start over strategy in Japan, but that window will close. When global Bitcoin treasury companies begin competing for the same yield-hungry Japanese investor base, Metaplanet's first mover premium may compress. None of these risks are insurmountable, but they are the factors I would track closely as Mars scales from private institutional placement toward the public retail market. Final thoughts. Mars is, in my assessment, one of the most strategically compelling financial instruments in the Bitcoin treasury universe right now. It combines the capital efficiency advantages of non dilutive preferred equity with the yield generation power of Japan's Bitcoin options business, all targeted at a domestic savings pool of extraordinary size and urgency. The market potential is real. Even conservative penetration of Japan's 1,122 trillion yen deposit base would represent a transformational capital raise by any standard. The structural design, adjustable monthly dividend, no conversion rights, senior in the capital stack, is precisely calibrated for the conservative pre-market seeking Japanese retail investor who currently earns next to nothing on their savings. The Bitcoin income generation business, already delivering over 50 million US dollars in annual revenue and growing rapidly, is the keystone that makes the legal and financial structure viable. When I ask my core analytical question, does this increase Bitcoin per share? The answer for Mars is clearly yes, and more powerfully than almost any other tool in Metaplanet's capital markets toolkit. That, ultimately, is why I think Mars deserves the serious analytical attention it has not yet fully received in Western financial media. Thank you for your time. Disclaimer: this presentation reflects personal research and opinions and is for informational purposes only. It is not financial advice. Markets are inherently risky. Always do your own due diligence and consult a licensed financial advisor before making any investment decisions.